Gold going up. $4,000 it's just gone through in US dollar terms, $6,000 in Aussie dollar terms. Let me just put the gold sector in perspective for you, just in case you feel as if you are an idiot for not being in gold. As far as the Australian market's concerned, if you take the ASX 200, gold stocks are about 2.5% of the ASX 200. So most fund managers in Australia feel no pressure to hold gold or hold gold stocks. And if they were under pressure, they might just hold. There are three big ones that are in the ASX 200, Evolution Mining, Northern Star, and there's a tail of others, Newmont as well, although the weighting's very small. And most fund managers would just hold them in a neutral weighting and forget about gold. So what's happening in the market in gold at the moment is it's being written up everywhere. It's getting a lot of media coverage, a lot of commentators talking about it. And you'd get the impression that this is the only story in Australia and the Australian stock market. But it's rather like being in the casino and you are there for 8 hours and over in one corner, there's this massive party going on, everybody jumping up and down about how fantastic everyone's a winner over in that corner, and you think you should abandon the main floor and head over to the corner. Gold is niche. And yes, people have made loads of money on gold. Yes, it's seen as a safe asset class. So it was risk reward was so obvious, but you missed it. So my message to you is don't worry about if you've missed gold, because they are small. From a stock's point of view, they're small, they're volatile, they're risky. You didn't need to be in them. As far as the gold price itself, which you can access through gold ETFs, yes, maybe it was quite an easy theme this year in hindsight, but let me tell you, when it turns, it's going to turn quite fast. What's been driving it has been four things probably. The first one is interest rates are expected to go down. Gold has no yield. It competes with asset classes that yield something. And if the asset classes that yield something yield less, then gold is more competitive compared to them. So the idea is gold goes up when interest rates go down. They've started to go down. The other driver has been central bank buying, and this is probably the main driver. And the thoughts are that there are fears about the US debt situation, not this year, possibly not in 5 years, but even if it's in the next decade, then the countries that have got huge bond holdings in the US, Japan and China need to start worrying about switching them into something else. And gold is the obvious asset class. So central bank buying of gold is a very strong underlying driver this year. Ever since we got the real debt scare in the US in April, after all the tariffs were introduced, everyone started realizing this really could go wrong at some point, the US access to the bond market, in which case we better get out of bonds. That's driving it. The other thought is that the Chinese are building their own gold reserves up. If they ever expect the Chinese yuan to be a reserve currency, it's going to need to be backed by gold. So they are buying as well. The other thing that's been driving it has been the drop in the US dollar. Anything priced in US dollars has by definition this year gone up 12% because the US dollar's gone down 12%. So the currency drop, the US dollar drop, is driving the gold price. The other thing that's driving it higher is exchange traded fund demand for gold ETFs. Some of the gold ETFs actually buy physical gold to back someone's investment in their ETF. So the more buyers there are for a gold ETF, the more demand there is for gold, the higher the price goes, because it's a very tight supply, gold. You can't just pop it out of the ground, hand over fist. It's a slow process. So all sorts of things are driving the gold price. And on the back of that, you might say, well, I'll just buy gold. It's safe. It's a store of value. Let me tell you, gold goes down as well as up. Even the central bank buying will pause if it thinks the price is, they're going to be able to get it lower down. They will get it lower down. I think the things that will short term halt the gold price is the US government shutdown ending, that sort of helped the gold price. If it ends suddenly, that might come off. If the US dollar starts to go up, that'll bring the gold price down as well. And if the market tips over, I tell you, it doesn't matter what it is, it can be an exchange traded fund over gold, people will be selling and getting into cash. So be careful with gold. One, you don't need it. Two, it's right up there. And three, it's not safe. It is a commodity price. It's vulnerable. Be careful out there. So it puts gold in perspective. If you haven't bought gold, this is probably in the middle of a boom in the gold price. Probably not the moment to start. Hi, I'm Marcus at Marcus Today. The newsletter's been around for 27 years. We've got two options for you. The first option is to do what everyone's been doing for 27 years at Marcus Today. The self-directed investors looking after their own investments using all the information, education in the newsletter, and sometimes copying our income or growth portfolio or strategy portfolio or Henry's small caps. We have another option now, which is the Marcus Today strategy portfolio, which is a real fund. It's been running since February. At this point, it's got over $60 million in it. It's growing very rapidly. We have a target 20, which is a rather ambitious target to get a 20% return per annum. And you now have the option to invest in that. So I invite you to try or come and invest in the Marcus Today strategy portfolio. You've got 100% transparency. You can subscribe to the newsletter, read about it every day, and that should provide a low volatility, high transparency investment option, which suits pretty much everyone.